Hello, everybody, and welcome to another Virtual Investment Summit by Fund Society. Today, we're talking with Schroders about how to build a truly diversified, sustainable portfolio. Katherine Davidson, the lead portfolio manager for the Global Sustainable Growth at Schroders, will discuss their proprietary approach for evaluating the durability of companies' earnings and identifying high-quality businesses that can survive in changing times. But before I introduce you to our moderator, I want to remind you that you can post your questions every time during the event. You can do it on the Q&A section on the app, or you can just send us an email at info@fundsociety.com. You can post them either in English or in Spanish. So I'm glad to present our moderator, Toro, Cristian Reynal, the Sales Director for Argentina and Uruguay at Schroders. ¿Cómo estás, Toro? How are you?
Elena, buenos días. Good morning, and thank you for giving us the opportunity to showcase our sustainability approach today.
Thank you for being with us. So, floor is yours.
Thanks so much. So, as Elena just said, guys, please, by all means, send us questions, comments, whatever's on your mind. We want this time to be valuable for you. So I'm joined today by my colleague and lead portfolio manager of our Schroders Global Sustainable Growth Strategy, Katherine Davidson. Katherine's graduate from Oxford University, and she holds the CFA designation. And the idea for us today is to hopefully convince you of three things. Number one, let's understand what's ESG and why it is important in today's environment for you as asset allocators and for your clients as investors. Number two, how do we approach sustainability, ESG in Schroders? Why we are pioneers in this space and we are not just greenwashing things as we hear today. And number three, how Schroders Global Sustainable Growth can be a core portfolio for your clients to start investing in sustainable equities. But before we jump into the conversation with Katherine, let me first show you a very brief video of one of the ideas that Katherine has incorporated in her portfolio that hopefully allow us to show what we believe is sustainable investing. So, Elena, we can go into the video if you want.
Mobile phones have proved essential in regions of Africa where it's easier to erect masts than lay cables. But increasingly, the benefits of telecommunications go beyond connecting people through calls and texts. One business in particular, Safaricom, has been credited with pioneering a mobile-based payment system in 2007. Called M-Pesa, it's allowed millions of people to make secure, cashless transactions by SMS instantly, even where there aren't banks for thousands of miles, and even if they don't have a bank account.
Safaricom is the largest mobile network operator in Kenya. It has an attractive track record of growth and profitability, and its 3G network covers 94% of the Kenyan population. Africa is such a young market. 75% of the Kenyan population is under 35. So we expect businesses and services based on connectivity to boom. But there is another part of the story. which is the transformative effect that M-Pesa has had on society.
Before M-Pesa, if urban workers wanted to send money to rural family members, they might have put cash in an envelope and entrusted it to the bus driver. M-Pesa has enabled people to start and grow businesses and access life-changing services. It could pay for an ambulance taxi to a rural hospital in an emergency, such as a difficult labour. It allows farmers to buy crop insurance. It opens up the opportunity to save.
In the same way we monitor financial performance, we track the social benefits a business generates. Safaricom commissioned KPMG to quantify its wider societal impact and found that the true value of its business was 10 times its profits and more than 6% of Kenyan GDP. This was driven by direct and indirect job creation, infrastructure and investments.
The UN has said that the expansion of mobile money has lifted 2% of Kenyan households above the poverty line. The effect of mobile banking has been even more significant for women. It's helped 185,000 women move from subsistence farming to better paid work.
We're looking for businesses that are going to succeed in the long term. And we believe that firms like Safaricom with a purpose beyond profit will be more durable, which could mean lower risks for investors. It should also mean that they're better able to deliver value to all their stakeholders, including, but not limited to, their investors.
Wonderful story. Katherine, good afternoon. Thank you for joining us. Pleasure to have you here.
Buenos dias. Hi, Toro.
Hello there. So let me kick off with probably the most important question I have as an investor myself. Is there a trade-off between sustainability and returns?
Well, I've obviously got a horse in the race here, but I very strongly believe that there isn't. So when you think about ESG initiatives, I think you should think about them like you would any other investment, that there's a short-term cost sometimes, but it comes with a long-term payoff. So you can think of a simple example such as installing LED lights results, it costs you something up front, but it results in lower energy bills forever. Investing in training for your employees improves their productivity. So like any other corporate activity, there's a sort of payback period and a return rate for these investments. So in the long term, we believe the interests of other stakeholders are broadly aligned with those of shareholders. And we like to refer to this as a kind of corporate karma, whereby the way companies behave comes back to impact their financial performance. There's not always a visible payoff in terms of the financial side, like the examples I gave, but sometimes it can be about avoiding risk as well. So it's the things that don't happen. So having whistleblowing lines prevents fraud, having good health and safety standards prevents expensive accidents, environmental standards. So that's one of the reasons that these kind of companies tend to perform better.
Perfect. Very, very clear examples. So you've been with Schroders from 2008, if I'm not wrong, and you've probably seen the whole evolution, let's say, of our sustainability approach. Can you maybe explain what is it that we've done in the past and how we really have an expertise on sustainability and we're not late in the race?
Yeah, sure. You're making me feel old there, but I have nearly seen the whole journey. So Schroders recruited its first dedicated resource was as early as 1998, actually. So he was here long before I started. So we've been doing this way before it was cool. And we've now got, I think, over 20 full-time employees working on ESG and sustainability with over 200 years of combined experience. We've been a member of the PRI since 2007, and we've been A+ rated for the last 6 years. More recently, I would say in the last 5 years, we've seen a real acceleration in the wider industry, but we regard Schroders as being very much at the forefront. So, for example, we've got a great suite of in-house proprietary tools, some of which have won multiple industry awards. We were recently a founding member of the Net Zero Asset Manager initiative, so we really are practicing what we preach as well.
Wow, that's impressive. I've also heard our CEO sent a letter to his counterparts in the FTSE 350, kind of demanding to know from them what they are doing with regards to climate change, right?
I'm sure he would say it was much politer than that. But yes, we wrote to all of the FTSE 350 requesting that they put in place a transition plan for net zero and sort of laying out the framework for how they would achieve that. And that's what we're also endeavouring to do at Schroders, thinking about both our corporate activities and also our investment portfolios and how we get those to net zero over the next few decades. And we're not stopping at the FTSE 350. We're about to expand this kind of engagement activity across Europe and eventually more globally. But actually, we've had really good feedback from companies in the UK. A lot of companies have wanted to work with us on understanding best practices for net zero. And we've participated in a lot of companies' materiality assessments and stakeholder reviews, for example. So I think we're seeing encouraging signs from the corporate side.
That's amazing. Congratulations for that. You just mentioned a few minutes ago that you have
rather than me.
you mentioned you have, or we have actually, proprietary tools to assess ESG. Can you maybe touch on a few examples of what you mean with that? I mean, I know that you don't rely really on third-party ratings on that regard, but can you maybe develop further on what kind of toolkit you have available as a portfolio manager?
Yeah, so we're really lucky here, the investors, that we have such a great team behind us and also a huge sort of data analytics and enablement team. And I struggle to keep track, but I think we've now got more than 10 proprietary tools, of which one of our flagship ones, I guess I'll call out, is SustainX, which is, I think it was referenced on the video actually, that we are trying to measure the non-financial impact of the companies we invest in. And SustainX is a tool that's sort of designed to weigh up the costs and benefits that a company has on society beyond its profit. So it's like asking if a company were to get a bill or a credit note at the end of the year for, carbon emissions and damage to health offset by their, investments in their local community, then what would that look like in hard dollar terms? And then you can aggregate that up at the portfolio level. So that's been really well received by clients. We're also developing a tool called ThemeX that's going to be able to illustrate alignment with sustainable development goals, a climate alignment tool. So there's a load of stuff in our toolbox. And as you said, we really feel very strongly that this is something that should be done in-house, because it's just too important to outsource it to a third party. You wouldn't do that with any other part of your investment decision. So why do it with your ESG analysis?
Absolutely. Well, I'll be curious to see the results of that SustainX numbers on your portfolio in particular. We'll see how that looks.
They're fine, obviously. They're good.
Sounds good. So let's see. ESG, let's say, is kind of the building blocks of sustainability. Now, what makes our approach different? How do we look at ESG and differ from the old and traditional, risk and return, backward looking? And why is it that you end up finding, jewels like Safaricom with what they've done with M-Pesa? Do you look further away from the stakeholders? What's the magic recipe?
Well, if I could formulate it, I probably wouldn't share it on TV. I personally, and I think as an organization, we've now moved beyond talking about E, S, and G, because those are really sort of blunt buckets to try and capture a lot of complexity. So we tend to think about sustainable investing more in terms of a wider set of stakeholder relationships. So you've got the environment in there, but you've also got, employees, customers, regulators, communities, and investors are also a stakeholder. So it's about sort of a holistic view of how a company manages all of those and the potential conflicts between them. So our Andy Howard, our head of sustainable investment, has sort of long coined the phrase that companies don't operate in a vacuum. And I think it's having this broader conception of sustainability combined with those proprietary tools that enables us to find companies that might not be in everyone's portfolios, because you're not just crowding into the same research that everyone else has done. And you can be a bit more diversified if you're looking at how companies do things as well as just what they do, which is how a number of thematic funds tend to be structured.
Agree 100%. So let's jump into examples. I'm a firm believer that with an example, an investor and an asset allocator can understand a point much better. Firstly, curious to know, do you have any LATAM stocks in your portfolio, and how do you see LATAM firms approaching sustainability?
So we haven't got a huge representation, but we have got one Brazilian name in there, and also a multinational with a lot of LATAM exposure. So I would say that, like most emerging markets, LATAM is further behind the curve than at least Europe, because there's just a lot of legal requirements in Europe for companies to disclose certain things, and also European investors have been more demanding for companies. The Nordics were way ahead of even us in the UK, so we're just a little bit further along that journey. But I think there are a lot of companies in emerging markets, including LATAM, that have been doing the right thing for their entire corporate history. They just haven't really been calling it ESG or publishing a report about it. So we think it's really important to have a relationship with the companies and to have feet on the ground locally to help us find those. So our name in Brazil is Raia Drogasil, which I'm sure many of your viewers will be familiar with. They're a pharmacy chain, and we really like the company's structural growth profile, driven by growing demand for accessible and affordable healthcare and population aging demographic trends in Brazil. And there's also a positive societal impact from the provision of healthcare at the point of need in a country without a huge sort of state system. And I like the fact as an investor that they have a durable competitive moat that is partly down to their management of their stakeholders. So in particular, the way that they interact with their customers and their extremely high customer service standards. So they have in like every single store, they have these terminals where you can evaluate your transaction after you pay. They have a great loyalty program that most of their customers now use. They have an omni-channel offer, and they were really good about improving their sort of e-commerce offering during the pandemic, as well as offering online medical consultations. So it's a management team that I think really gets it in terms of looking after the key stakeholders for their business and has aligned incentives for the long term. Oh, and the multinational would be BBVA, who are a Spanish banking group, and they own Bancomer in Mexico, and have big presence in a lot of LATAM markets, which is one of the reasons we like the company, because of the growth in those markets. And again, they've partly got to that position because of their customer-centric approach and their innovation in digitization and fintech. So again, this is another thing where they've sort of invested up front in order to secure the long-term durability of their franchise.
Absolutely. And it's interesting that you mentioned the pandemic, because I believe this kind of brought up to the surface all of the sustainability issues, let's say, not just around environmental, but maybe most importantly, social. And right now, with all of the debate going on around minimum taxes, corporate governance, right? So I have another question. I mean, I know, based on what you've just said, for you, sustainability is not about exclusions, simply, right? But we know many managers out there, they would label ESG a fund that doesn't invest in weapons and alcohol and tobacco, etc. Maybe digging deeper into your approach, have you seen any big important names that you don't feel comfortable with based on your sustainability considerations that are maybe worth mentioning? Not to pick on those names, but to kind of understand your investment rationale.
Yeah. So as you say, we've tried to take a more inclusionary approach in this strategy rather than exclusions, because exclusions are just we do have those usual exclusions, but that's just a screen that any manager can apply, and it only captures the very worst offenders. Whereas we're running a concentrated portfolio, and we really want it to be the best of the best, not everyone that's not the worst, as it were. So we have very high standards for the companies that we allow into our universe. And we've rejected quite a lot of names. We reject about half of the names that we look at, and that's already after an initial screening process. So some of the high profile names, so names like Facebook, we have not had in our investment universe, and we decided several years ago now that we were not comfortable with the sort of fundamental business model there, nor with the corporate culture and their internal controls. And perhaps more surprisingly, we removed Nike from our universe last year after concerns over their corporate culture, the Salazar doping scandal, and concerns about sexism at the organization. And also we have compared the company very closely with Adidas, which we own in the portfolio, and found that their environmental credentials and their supply chain management are much weaker, despite their very good PR. And a more recent example might be, we were just looking at American Express as a potential idea for the fund. And we ended up rejecting that partly because of concerns about how much their business model is premised on air miles, and whether that was really going to be a socially acceptable way to incentivize your customers in the future when we all need to do less flying.
Wow. Yeah, I mean, I know airlines and commercial flights, they contribute a lot to carbon emissions. But the other industry that I know that contributes a lot to carbon emission is the clothing industry. And someone in the organization told me that, I don't know if it's because of that or why, but that you do most of your clothing yourself. Is that true?
Probably most would be an exaggeration, but I'm working towards it. If I was a little bit faster, it would be most. But yeah, as you say, I think one of the things about working in this space is that I've learned a lot about how much my daily consumption impacts the planet, and also the social sphere. And you can't be around those stats all day without wanting to make some changes. So with regard to apparel and footwear, constitute about 10% of the world's greenhouse gas emissions, which is more than international flights and maritime put together, which are just enormous. And the water usage as well. To make one cotton T-shirt that would use about as much water as a normal person would drink in 2.5 years. So it's a hugely environmentally intensive sector, and there's really no way around it. There's no good material. There's, synthetic fabrics are better on water but are worse on petrochemicals. It's very hard to be a responsible consumer in apparel. So what we really need is a fundamental change in how we think about ownership and consumerism. We need to buy less stuff and use it more. And maybe, there's been a big takeoff among younger consumers of sort of reuse and rental platforms or secondhand shopping. That's great to see people embracing that. So especially since the pandemic, seeing as I couldn't go out and shop anyway, I refreshed my sewing skills and did a couple of online courses, and I have been trying to turn out more of so I wore something today that I made because I had a feeling that this might get mentioned. Since the marketing team found out, they insist on showcasing it in every presentation.
That's amazing. I doubt I'll ever be able to sew my own shirts, but I promise I'm going to try and use them more often.
Okay, shirts are really hard,
guess,
actually. I'm not doing those.
I guess you're particularly proud. I mean, I was lucky enough to visit our new headquarters in London, and they seem to be really, really a good, let's say, sustainable or green building in the area, right?
Yeah, I think we won some awards for from the City of London and from various building authorities for having the most green building, and we got rid of all the single-use plastic. We've got grey water facilities for all the sort of bathrooms and everything. It's also a really lovely place to work, but it's nice to know that it's much greener than our old building as well.
Nice, nice. Glad to hear. So I know we've been talking for 20, 25 minutes now. Probably the audience has a lot of questions. Even before I jump into your portfolio, I'd rather bring in Elena into the conversation as well and see if we had any questions coming from the audience for you. Elena, you're around.
Yes, thank you, Toto. Thank you, Catherine. Yeah, I have a few questions actually. Some of them you already covered it, but I have a few questions. For instance, how can you discern companies that have a genuine commitment to sustainability from those that only have a good sustainability reporting policy?
That's a really good question, and that comes back to the sort of point about greenwashing. And I think it is almost getting harder because the more companies are required to disclose, the harder it is to use that as a differentiator. So I think this is where it pays investors to kind of do their homework and to have a relationship with the companies, because you can usually tell quite quickly when you start talking to a management team whether this is something that belongs in its own little department with its own reporting, or whether it's something that's really integrated into the corporate culture. And the other way you can tell is by trying to find data points or information that doesn't just come from inside the company. So sort of cross-checking the company's reporting with other things from NGOs, from other interest groups, looking at data from Glassdoor, the employee reviews portal. I always find absolutely fascinating, and that can tell you things like whether diversity is actually taken seriously at the company or whether it's just something that's part of their PR campaign.
Thank you. I have a good one. What about Amazon and their labor policy?
Yeah, so Amazon is not a company that we own in the portfolio, and it is
low wages. Actually, it says low wages.
Yeah. Okay. Well, actually, I think low wages is possibly not the thing I would pick up on here, because Amazon's wage policy is actually relatively good by the standards of US retail. So when they brought in their $15 minimum wage last year, that actually forced a lot of their competitors in retail to raise their wages to similar levels. I think the bigger concerns have been around working conditions rather than about pay. So some of the shock stories in the papers about people not having enough time off to go to the bathroom, etc. And while some of that's undoubtedly exaggerated, we do have real concerns about treatment of warehouse employees and potentially contractors, where you get really low visibility into how much they're paid and their benefits packages. And also about Amazon's treatment of whistleblowers when it comes to its employee relations, where we've seen many of them be retaliated against by the company, which is really bad practice, and to us just sort of gives a bad impression of the overall corporate culture and procedures at the company.
And another question related. We have recently known about how some of the richest people in the world, like Bezos, Buffett, Bloomberg, Musk, to name a few, pay only a tiny fraction of their wealth. Should this affect the value of the companies they own?
Ooh, that is a really interesting question. I mean, it's obviously part of the governance is assessing the sort of behaviours and characteristics of the management team. But a company is not its chief executive, and ideally, as a long-term investor, you're looking for a company that isn't reliant on one particular key man, and has the sort of underpinnings to survive through multiple successions. So those businesses are somewhat exceptional in that regard, in that, Tesla is nothing really with, well, it's not nothing, but it's got a significant key man risk in Elon Musk, and ditto, Berkshire and in Warren Buffett. And in that case, I think you have to sort of try and take a judgment about how much risk that imposes on the company, either from a reputational point of view. Are people going to boycott Amazon because Jeff Bezos doesn't pay any tax? Probably not. But on the other hand, it may well feed into, a sort of general anti-Amazon or anti-big tech feeling among regulators. And there's a big effort to close tax loopholes at the company level that may well be enforced by this sort of public personal tax issues.
Mm-hmm. And we have a couple of questions about your approach. So you have 4 broad pillars: environment, relationships with stakeholders, corporate citizenship, prudent allocation of capital. Are these 4 pillars equally weighted? And have you do any changes recently with the pandemic crisis? Like, have you give more weight to any of those pillars?
Interesting. Your questioner is obviously very well informed about my fund. Yeah, so what we use to assess companies is a 20-question framework that sort of roughly breaks down into those 4 categories. But the idea is that it's questions rather than criteria or data, because you want to promote discussion and debate, because these are all sort of things with the grey areas. They're all very subjective, rather than being able to sort of plug them into a formula. So we actually haven't gone down the road of sort of playing around with weightings for anything. We just have these 20 questions in those 4 categories, and what we focus on for each company depends on the most material stakeholder relationships for that company. So it's not about achieving a certain overall score. It's about are they good where it matters, and if there's weaknesses in other areas, then that's something we can engage with the company to help them work on. So for a bank, you're probably not going to worry too much about their environmental impact. It's a nice to have, and it tells you something about the company's approach, but it probably isn't a deal breaker. Whereas their sort of human capital management and their treatment of customers and their business ethics would be a much bigger deal. Whereas for a manager, you want to focus more of your time on the environmental side and the supply chain. So there's sort of the weights in the discussion shift, but we don't think we'd be adding much value by actually, trying to play around with an algorithm. It's much more like fundamental analysis. It's about reaching a reasoned decision using all the information that's available. And with regard to the pandemic, I think we already felt that social was the underappreciated area of ESG, and E had especially got a lot of attention in the preceding year, with Extinction Rebellion, etc. And the pandemic really brought social to light, and we wrote a lot last year about how important this factor is, and the role of companies in wider society and in supporting those stakeholder relationships. So I think it's raised it in a lot of people's estimations, but it would be a bit arrogant to say it's just validated it in ours.
Katherine, if I may jump in, not sure if my mic is on. You just mentioned engagement. Perfect. You just mentioned engagement. Was there any case of a particular firm where you liked the sector where they were playing, you liked the theme in terms of investing for the long term, but there was something that didn't sound okay with regards to their sustainability approach, where you were able to speak with their management and understand where they were going, or maybe make your own case and have them change their mind?
Yeah, all the time. So it's a huge part of our process at Schroders more generally, and in this fund specifically, that we engage from the moment that we start looking at a company. Often there's, as I've said before, there's differences in disclosure in different geographies, so you can get a much better feel for whether a company is actually committed to things, and you can get some additional data by speaking to them directly. And as you say, you can then sort of help them improve on those areas of weakness. So we are regularly engaging with several of our holdings, and we've seen some really nice stories of improvement. It doesn't tend to happen really quickly, but if you're a long-term investor in a company, you can help drive change. So, for example, on the net zero stuff, we have seen some great steps forward by companies on that front since we started engaging. There's a Japanese company in my portfolio, Recruit, where we were having conversations with them last year about net zero targets and about how one goes about setting and measuring those. And they just implemented new targets in May to that end. So that was really positive. And they also, we've got another AIA, an Asian insurance company, where we wrote to them recently about increasing female representation on their board, and they have subsequently added another woman to the board, so they're now one of the highest diversity ratios in Asia. I could go on for ages, but I think hopefully you get the idea that by sort of having a collaboration with the company, you can help drive change.
Oh, that's amazing. That's amazing. I mean, I guess from my end, if there's something clear to me, is that in today's world, all of the global brands, all of the global franchises, all of the global firms, if you may, they want to be sustainable. They need to be sustainable in order to succeed. So I think we're on the right path. Not sure if, Elena, if we have any more questions from the audience.
Yes, we do. I think we have time for another question. Actually, you talked about this at the beginning of the event. Are investors changing their view about the? Actually, I think it's a question for both of you. Are investors changing their view about the potential trade-off between sustainable investing and generating market-beating returns?
Sure. Shall I start, and then Toro can chip in? So I think again, 2020 was a really a key turning point for the debate here, because through the pandemic, sustainable funds in general significantly outperformed the wider market, especially in the initial sell-off phase. You know, these funds tend to hold higher quality companies, and those better stakeholder relationships were definitely rewarded in that difficult time as well. You know, companies that had good systems already in place with regard to, looking after their employees and managing their supply chains, etc. So that year of really strong performance, and the fact that most ESG funds are now getting to a sort of longer track record, now it's a more established space, I think is definitely enabling, it's assuaging the concerns that some people had about the trade-off. Toro?
Yeah, I mean, absolutely. You mentioned some of these at the very beginning, but I guess, at the end of the day, a firm that doesn't comply with regulations, needs to pay fines. A firm that doesn't pay a competitive salary to the employees, get much more turnover. And all of us know that when you have, employees with lots of turnover, there's a much higher cost because you have an empty seat. You need to hire a consultant firm in order to get a new employee, etc. And the last thing that I guess it's very, very important with the new generations is the impact on demand, because you see the younger generations that they say, I'm going to judge what you're doing to the environment, what you're doing to the society by not buying your product. And that's it. So it's definitely impacting the bottom line on the revenue front.
And interestingly, not working for you as well as not buying your product. So I saw a great study the other day by Deloitte saying that 80% of people wouldn't work for a company where they sort of didn't have, the same values as them, and in particular on diversity inclusion. And that among millennials, over half of people would move jobs if it weren't aligned.
Okay, well, thank you very much, Catherine. It was super interesting. Thank you, Dodo. And of course, thank you, Schroders, and thank you to all our readers for joining us in another event. And there will be a recording available in our website, so you can go ahead and access to the recording. So thank you very much. Stay safe. Ya, ¿no?